Welcome back to the Longacres Finance channel. The stock market keeps on falling this year, and I know many investors are becoming discouraged and starting to worry about the future. During turbulent market times like we are experiencing today, I like to find solace in historical data. History tells us that bear markets occur every 56 months, or just a little longer than every 4.5 years. The most recent bear market started on June 13th for the S&P, while the Nasdaq entered its current bear market on March 7th. The average bear market lasts for 9.6 months. So based on historical measures, we are in the early stages of the current bear market. While many seasoned investors may remember the 2007 to 2009 bear market that followed the financial crisis, and perhaps even the 2000 dot-com bubble crash, both of these bear markets, while horrible, pale in comparison to the 1929 Great Depression. In the 2007 bear market, the S&P had a decline of 56.8%. In the 2008 dot-com bubble, the popular index fell 49.1%. But in the 1929 Great Depression, the S&P lost 86.2% of its value, and it took nearly 2 decades to recover from those slumps. There's no way to foretell the final outcome of the current bear market, but one thing is for certain. The stock market will recover, and if you follow a dollar-cost averaging strategy, your portfolio will be just fine a few years down the road. The key is to position yourself properly so that you can benefit from the inevitable bull market that is going to follow. Now, the most popular and the safest investing strategy is using a combination of index funds to maximize your risk tolerance between equities and fixed income. However, if you prefer to invest in individual dividend growth stocks, here are 8 great companies that I believe are attractive value today and should perform better than average in the future. Please note that this is not investment advice, and you should always perform your own due diligence before making any investing decision. Up first, we have Applied Materials, that provides manufacturing equipment, services, and software to the semiconductor, display, and related industries. It operates through 3 segments: semiconductor systems, applied global services, and display and adjacent markets. The company has been around since 1967, and it ranks very well on my business quality screener. My process for investing is simple. I look for high-quality businesses that are priced attractively today. To determine the quality of a business, I review their historical and current financials and operating performance. To determine whether the share price is attractive, I like to use dividend yield theory or price to free cash flow. Today I'll be showcasing the price to free cash flow metric. I think it's superior to the dividend yield theory measure, especially for low-yielding stocks. Applied Materials has a price to free cash flow ratio of 15.49, based on its trailing 12-month financial data. The 5-year trailing average price to free cash flow ratio is 18.03, implying a potential 14% undervaluation. And the 10-year trailing average price to free cash flow ratio is 19.58, implying a higher potential 21% undervaluation. Based on the trailing averages, I come up with a fair price to pay for the stock today, between $104 and $113. On June 16th, the stock closed the day with a price of $89.59, which was 14 to 21% below the fair price range. I don't know which way the price will move in the short term. It could very well fall into the 70s or 60s, or it could shoot back up above 100. What I do know is that based on my assumptions, the price looks attractive today, and it makes sense for me to dollar cost average into my position. And that is exactly what I am doing. Matter of fact, I invested more capital into each of these 8 stocks I will tell you about today. Up next, we have Expeditors International of Washington, that provides logistics services across the globe. That includes both air and ocean freight, as well as many other services involved in the shipment of products. Expeditors has a price to free cash flow ratio of 18.59, based on its trailing 12-month financials. Its 5-year trailing average price to free cash flow ratio is 22.52, implying a potential 17% undervaluation. And the 10-year trailing average price to free cash flow ratio is 22.24, implying a potential 16% undervaluation. Based on these trailing averages, the fair price to pay for the stock today would be in the range of $115 to $117. The company has seen free cash flow increase for 7 out of the last 10 years, with an average growth rate of 17.42%. Diluted shares outstanding have declined for 9 out of the last 10 years, at an average rate of 1.94% per year. Up next, we have SS&C Technologies, that provides software products and services to the financial and healthcare industries. Based on the trailing 12-month financials, the company has a price to free cash flow ratio of 10.74 right now. The 5-year trailing average price to free cash flow ratio is 15.39, implying a potential 30% undervaluation. The 10-year trailing average price to free cash flow ratio is 16.8, implying a higher 36% potential undervaluation. The trailing average gives us a fair price range for the stock between $79 and $86. SS&C has increased its free cash flow for 7 out of the last 10 years, growing at an average rate of over 100% per year. Diluted shares outstanding have increased at an average rate of 6.12% per year during the last decade, giving us a lower, yet still impressive, free cash flow per share growth rate of 62.74% per year. Up next, we have Intercontinental Exchange, that operates regulated exchanges, clearing houses, and listing venues for commodity, fixed income, and equity markets across the globe. The company currently trades for a price-to-free cash flow ratio of 18.04 based on its trailing 12-month financials. The 5-year trailing average price-to-free cash flow ratio is 20.55, implying a 12% potential undervaluation. The 10-year trailing average price-to-free cash flow ratio is 19.79, implying a slightly lower 9% potential undervaluation. Using the trailing average price-to-free cash flow ratios, we can come up with a fair price for the stock in the range of $104 to $108 today. The company has increased its free cash flow for 7 out of the last 10 years, with an average growth rate of 32.37% per year. The number of diluted shares outstanding has also increased at an average rate of 5.47% per year. However, since 2016, the diluted share count has been declining. Up next, we have T. Rowe Price Group, that you must have heard me talk about if you've listened to any past episodes, and I'm going to keep talking about this company until its price recovers. T. Rowe is a publicly owned investment manager for both individuals and institutions. The company has a price-to-free cash flow ratio of 7.3 based on its trailing 12-month financials. The 5-year trailing average price-to-free cash flow ratio is 15.74, implying a 54% potential undervaluation. The 10-year trailing average price-to-free cash flow ratio is 16.5, implying a slightly higher 56% potential undervaluation. Based on these trailing averages, the fair price for the stock today is between $229 and $240. T. Rowe has increased its free cash flow for 8 out of the last 10 years, at an average rate of 30.27% per year. Diluted shares outstanding have shrunk in 6 out of the last 10 years, at an average rate of 1.23% per year. Up next, we have Visa, who everyone should know and likely have one of their credit or debit cards in your wallet. Visa is a payment technology company that operates across the entire world. Based on its trailing 12-month financials, the company has a 26.79 price-to-free cash flow ratio right now. The 5-year trailing average price-to-free cash flow is 32.05, implying a 16% potential undervaluation. The 10-year trailing average price-to-free cash flow is 31.27, implying a slightly lower 14% potential undervaluation. Based on these trailing averages, we come up with a fair price for the stock between $220 and $226 today. Visa has increased its free cash flow in 5 out of the last 10 years, at an average growth rate of 22.98%. Diluted shares outstanding have shrunk for each of the past 10 years, at an average rate of 1.88% per year. Up next, we have Starbucks, the popular coffee chain, and it currently has a price-to-free cash flow ratio of 23.13. The 5-year trailing average price-to-free cash flow ratio is 25.31, implying a 9% potential undervaluation. The 10-year trailing average price-to-free cash flow ratio is 28.85, implying a higher 20% potential undervaluation. Based on these trailing averages, we come up with a fair price for the stock between $78 and $89 today. Starbucks has increased its free cash flow for 5 out of the last 10 years, at an average rate of 30.36% per year. Diluted shares outstanding have shrunk in 8 out of the last 10 years, at an average rate of 2.39% per year. And the final company today is Skyworks Solutions, that creates various semiconductor products, as well as markets its intellectual property. The company has a price-to-free cash flow ratio of 14.28 right now. The 5-year trailing average price-to-free cash flow ratio is 20.53, implying a 30% potential undervaluation. The 10-year trailing average price-to-free cash flow ratio is 20.44. That also supports the 30% potential undervaluation. Based on the trailing averages, we get a fair price for the stock in the range of $128 to $129. Skyworks has increased its free cash flow for 6 out of the last 10 years, at an average rate of 44.69% per year. Diluted shares outstanding have shrunk for 7 out of the last 10 years, at an average rate of 1.33% per year. There you have 8 attractively valued dividend growth stocks that I am currently dollar cost averaging into. Like I mentioned earlier, I don't know which way the stock market or the price of these 8 stocks will move tomorrow or next week. What I am confident about is that these are high quality companies and they look attractive at today's valuation. And for me, that's enough to warrant buying. I hope you enjoyed the content. If you did, please give the video a like and subscribe to the channel. Thank you for watching and see you next time.